Meet Solomon. A few years ago, he was working on a vehicle in his garage when a heavy truck part slipped and crushed his toe. The injury was severe enough that he couldn't walk, which meant he couldn't work. For months, he sat on the couch watching his lost income turn into deep financial stress for his family. Solomon and his wife Amber had been paying for Primerica life insurance, but when they checked to see if their policy could offer any relief, they hit a brick wall. The plan strictly required a terminal illness or an actual death to trigger a single penny in payouts. When a safety net requires the absolute worst-case scenario to open, families fall right through the gaps during very real, survivable emergencies. This chart shows exactly how Solomon and Amber's current Primerica policy is structured right now, in year 8. They pay about $158 a month to maintain $1.69 million in household protection. But the policy has a programmed cost trap. As they age, their monthly payment doesn't stay flat. It steps up sharply, eventually climbing past $300 a month. At the exact same time they are asked to pay more, the actual protection they receive shrinks. The coverage line drops down to $1.25 million. There is a secondary issue built into this plan. Amber does not own her own policy. She is attached to Solomon's plan as a spouse rider. You can think of it like a sidecar attached to a motorcycle. She is entirely dependent on his main engine. Staying in this stacked structure means paying a rapidly increasing price tag for a shrinking amount of protection, all while leaving one partner without the security of their own independent plan. There are alternatives that correct these structural flaws, starting with National Life Group, a highly rated institution that builds predictable, long-term safety nets. Their first correction is uncoupling the sidecar. Instead of a primary plan with a dependent rider, they issue two entirely separate policies. This grants Amber total ownership over her own coverage. If either of them decides to adjust their protection decades from now, they can do so independently, without having to pass a brand new medical exam. True household financial security requires both partners to have autonomous, independently managed safety nets. Now we can look at the mathematics of the first alternative. We call this Option 1, the budget optimizer. It is designed to prioritize immediate cash flow. Option 1 freezes coverage today. It draws a flat line at $1.69 million, stopping the drop-offs of the old plan. The premium drops to $149 and locks in permanently. Avoiding future price hikes leaves nearly $23,000 in savings by age 55. Option 1 is the mathematically superior choice for families who want to guarantee long-term savings without sacrificing their current protection. The second alternative is Option 2, the Max Protector. This path focuses on securing the highest possible payout for the family. Option 2 matches the highest peak the Primerica plan ever offered, $1.95 million, and locks that maximum level in indefinitely. To maintain this, the premium is $168 a month. It's slightly more than today, but guaranteed to never rise. Even with that small initial bump, Option 2 still costs about $16,000 less cumulatively by age 55 than the escalating Primerica trap. We measure true efficiency by looking at the cost for every $1,000 of coverage. By their early 50s, Primerica's structure is 2.7 times more expensive for the exact same coverage. Option 2 is the strongest replacement for ensuring a family holds the absolute maximum safety net available, completely insulated from future price hikes. Let's go back to that garage, the crushed toe, and the months spent staring at a growing stack of bills. Modern policies from National Life Group include a feature called Living Benefits. This changes life insurance into a financial asset you can use while you are still alive. These policies carry specific provisions for accidental injuries. A heavy piece of machinery falling and destroying a foot is exactly the kind of physical trauma this provision targets. Under this new plan, Solomon could have requested a cash advance directly from his own death benefit. He could have used that money to replace his lost wages and pay the mortgage while he recovered. Modern life insurance serves as an active financial shield. It offers real, usable support when you're hurt, keeping the family afloat during the recovery process. The math is clear. Families drain their hard-earned resources when they pay escalating premiums for shrinking coverage. Both partners in a household require the dignity and security of their own independent, securely owned policies. And your coverage needs to be equipped with living benefits that protect your income if you are injured and survive. Take a moment to review your current policy, look at your future scheduled premiums, and lock in a predictable, flat-rate plan before those costs step up. Life is incredibly unpredictable, but the cost and reliability of your life insurance should never be.